Chapter 6, Investing Basics, the Stock Market. At this point on your journey, work is going well. Even if it's slow, you're not stressed about it. You're actually considering investing more into your side business. You've got some money saved, but you're just trying to decide what to do with it. This chapter is for you. One of the biggest mindset shifts on the road to wealth is learning how to spend money differently. The difference between the rich and the poor isn't always income. It's what they choose to do with their money. Wealthy people tend to spend money on assets, things that either hold their value or grow in value over time. Poor and middle-class consumers tend to spend money on liabilities, things that lose value and liquidity almost immediately. Assets include things like tools that help you make money or increase your efficiency, investment property that brings in rental income or appreciates in value, businesses that generate cash flow or scale over time, stocks, ETFs, and index funds that grow with the market, education and certifications that increase your income potential. On the flip side, here are examples of common or unnecessary liabilities, things that tend to lose value or drain your resources. High-interest credit card debt, expensive cars, especially when bought new or on long-term loans, trendy clothing or gadgets that quickly depreciate, frequent dining out or luxury items beyond your budget, subscriptions and memberships you don't actively use. Being aware of the difference between assets and liabilities is a foundational part of changing your financial habits and mindset. This mental shift doesn't come naturally. As Americans, we're conditioned to be relentless consumers, buyers of liabilities. It takes awareness, discipline, and often a full reset in how we view and act with money in order to be a successful investor. The goal is to gradually transition your mindset and your habits towards buying assets more often than you buy liabilities. Once you start viewing every dollar as a tool, a potential seed that can grow into more, you'll begin to think differently. You start to not only realize the potential of the money you have, but also the wasted potential of money you've spent in the past. Even if you've been diligent with your saving, that alone is not enough. A savings account can protect you, but it won't grow your money in any meaningful way, and you are actually losing money in the long term if you factor inflation into the equation. If you want to build real wealth, you need to understand how to invest. Think of investing as an accelerated savings account. It's not just about setting money aside. It's about asking a powerful question. Where can I put my money in position to turn into more money? For some people, the answer might be investing in the stock market. For others, it might be investing in real estate, investing in their business, or investing in education to increase their earning power. The best investment depends on your current skills, network, personality, and resources. The key isn't picking the perfect investment from the start. It's learning to ask the right questions so the right answers begin to reveal themselves. Once you have decided on your investment vehicle, the next step is simple. Find someone who's already doing it well. Whether that's a mentor in mobile bartending, a friend or educator who invests in stocks, or a professional in the field you aspire to, don't try to reinvent the wheel. Tap into your network, introduce yourself, read books, watch interviews and instructional videos. Study people who are where you want to be and have done what you want to do. Whether in real life, in a book, or online, find a mentor. A big part of this journey is education. The more you learn, the better decisions you'll make. In today's world, and especially in the restaurant industry, you have more access to people and information than any generation before you. Your mentor may be on a YouTube channel, or they may end up being one of your regulars. There's timeless wisdom in this. Before you invest in anything, take time to understand where your money is going and seek the guidance of someone experienced. That's how you avoid common mistakes and costly missteps. Just as you wouldn't trust your money to a stranger, don't blindly trust yourself without preparation. I personally chose the stock market as my wealth-building tool. I chose this path because it has a low barrier to entry, and, just as important, I genuinely enjoy learning about the market and applying what I learn. For many of us, the world and language of the stock market is very foreign. But I assure you, if you can do 7th grade math, you are smart enough to be a successful stock investor. It's just that no one ever taught you. The reason why no one ever taught you is the subject of another book. But in this economy, it is my firm belief that no matter what path you choose, developing the habit and skill of stock market investing is crucial to preserving and growing your savings. By the end of this chapter, you will have some simple, actionable tasks to practice and build your confidence and investment prowess. Over the years, I've gained education, insight, and inspiration from channels like Earn Your Leisure and Minority Mindset on YouTube. If you are interested in growing your wealth via the stock market, start educating yourself. Find a platform like Webull or Thinkorswim to apply what you learn and practice taking trades with fake money, paper trading. Before I ever invested $1, I spent years studying strategies and paper trading. I made mistakes, tracked my growth, and built the confidence to begin investing real money. In my experience and opinion, periodic investments in ETFs, index funds, and fundamentally strong stocks are a great place to start for a beginner. I have found them to be, for the most part, more stable and predictable than, say, Forex or crypto, although these can be great investments as well. The right vehicle for you depends on your knowledge, lifestyle, risk tolerance, and willingness to learn. For the moment, let's talk about the basics and benefits of stock investing. Stock Investing Basics, a beginner's guide. For many people, the stock market is the most accessible and flexible investment vehicle. You can start with just a few dollars and scale as you grow. No special connections, no real estate agents, no employees, just you, your money, and your willingness to learn. But before you invest, it's important to understand what you're actually doing. What is a stock? A stock is a share of ownership in a company. When you buy a stock, you're buying a small piece of that business. If the company grows in value, so does your investment. If it loses value, your investment drops too. You don't need to be an expert to get started, but you should understand the basic types of stock investments. Individual stocks, shares of one company, like Apple or Coca-Cola. ETFs, exchange-traded funds, bundles of multiple stocks that spread out risk. Index funds, funds that mimic the performance of a market index, like the S&P 500. ETFs and index funds are usually less risky than picking individual stocks, especially for beginners. They're like ordering a combo meal instead of cooking every dish from scratch. What about dividends? Dividends are a way for companies to share profits with their shareholders. When you own a dividend-paying stock, you receive small payouts, usually quarterly. This can be a great way to generate passive income over time, especially if you reinvest those dividends to buy more shares. Some well-known dividend-paying companies include Coca-Cola, KO, known for decades of consistent dividend payments. Johnson & Johnson, J&J, a reliable healthcare stock. Procter & Gamble, PG, consumer goods with steady returns. PepsiCo, PEP, another strong dividend payer. The power of compounding. One of the greatest tools in investing is compound interest, earning interest on your interest or profits on your profits, over and over again. This is how small, consistent investments grow into large amounts over time. This is how small, consistent gains can be more powerful than home run investment plays. Here's a simple example. Question: if you invest $1,000, Which is better, a 40% profit or a 10% profit earned 4 times? If you earn a 40% return on $1,000 once, you end up with $1,400. But if you earn 10% on $1,000 4 times in a row, the results compound if you reinvest. First gain, $1,000, $1,100. Second gain, $1,100, $1,210. Third gain, $1,210, $1,331. Fourth gain, $1,331 to $1,464.10. That's a 46.41% total gain, not just 40%. The difference comes from compounding. Each gain builds on the last. If you are making regular contributions to your investment capital, or if your gains are higher, this process speeds up considerably. Now ask yourself, which is easier to consistently achieve? A 10% gain or a 40% gain? If you can manage to maintain small returns year after year, just don't lose money, you have a powerful wealth-building tool. The earlier you start, the more powerful this effect becomes. If you are a young person, I especially implore you to begin your investing journey at least by paper trading. You have the most time you will ever have to take advantage of compounding. Reinvesting your gains and dividends to your portfolio consistently over time, even in small amounts, can set a powerful foundation for your future. It's never too late to start, but the amount of compounding potential you miss out on grows exponentially by the year. If you can manage to get small, consistent gains on your investments and reinvest them for more small gains, you have the power to take advantage of what Einstein referred to as the 8th wonder of the world, compound interest. As Warren Buffett, the GOAT of investing, famously said, "Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. Lock that quote into your psyche. Don't chase quick wins or day trading hype. Even small growth is infinitely more preferable than losing money. Think of investing as planting money in fertile soil and giving it time to grow. We're not here to gamble or chase a quick, easy buck. We're here to strategically place money in a suitable spot for it to grow. If you plant seeds at the proper time of year and tend to them, your garden will likely thrive and bear fruit." Understanding the basics, technical and fundamental analysis. Most new investors overlook how much they already know. If you own an iPhone, wear Nike shoes, shop on Amazon, take Ubers, or scroll through Instagram, you've already identified quality companies. You're interacting with successful, publicly traded brands every day. With a little education, a moderately intelligent person can not only recognize a great company, they probably already have. If there is a company, product, or service that you are familiar with or use frequently, ask yourself, who owns this? Are they publicly traded? If so, you've identified a great candidate to practice fundamental and technical analysis of a company. Fundamental analysis. This method focuses on analyzing a company's financial health, like revenue, profit, debt, leadership, and industry strength. It helps investors decide if a company is a good long-term investment. The key skill here is learning to interpret an income statement and paying attention to relevant news. You're asking yourself, does this company make money? Or is it moving towards profitability? Trust me, it's not rocket science. In general, you want to determine whether the company is increasing their earnings and revenue quarter after quarter, year after year. If so, this is a sign of fundamental strength. Technical analysis. This method focuses on stock price movement or price action. Investors use patterns and indicators to decide when to buy or sell. The key skill here is learning to read and interpret a stock chart, identifying trends, interpreting candlesticks, and recognizing support and resistance. Your goal in technical analysis is to analyze a stock's price history and determine which price, if any, is the price you'd like to buy or sell that stock. Here are some basic terms. Candlesticks, a type of chart used to show price movements over time. Each candle shows the open, high, low, and closing price for a set time period. Candlestick patterns, specific shapes formed by one or more candlesticks that might indicate where the price is headed next, e.g. doji, hammer, engulfing pattern. Trend, the general direction. A stock's price is moving, upward, downward, or sideways. Support, a price level where a stock tends to stop falling and might bounce back up. Use support levels to identify your buy prices. Support levels tend to be stronger on longer chart time frames. Resistance, a price level where a stock tends to stop rising and might fall again. When prices hit resistance, especially on the long term, you may consider taking profits or trimming your stock position, which means taking profits on some but not all of it. Moving average, a line that shows the average price of a stock over a set number of days. It helps smooth out price action and spot trends. RSI, Relative Strength Index, an indicator that measures if a stock is overbought, too expensive, or oversold, too cheap. You don't need to master all of these at once, but having a basic awareness gives you a huge edge as an investor. If any of these terms seem fuzzy or confusing, I'd encourage you to research any of these terms on the aforementioned YouTube channels, or one of your choosing. TradingView is a great app to practice reading charts and applying what you learn. Mastering both fundamental and technical analysis gives you a more complete perspective. For most beginners, start by identifying companies you know. Look them up on TradingView or Yahoo Finance. See if you can identify whether they have been increasing their profits over the last 3 years. Then build your understanding of technical analysis by identifying the trend on a chart and marking support and resistance levels. Over time, use this skill to refine your entry and exit points. Dollar cost averaging, DCA. Dollar cost averaging, DCA, is known as a strategy that involves consistently investing a fixed amount of money over regular intervals, whether the market is up or down. But instead of viewing it purely as a way to smooth out price fluctuations, think of it as a strategy to strengthen your position in a fundamentally sound company. Let's say you own some stock in a company and you see that it is down 15% in your portfolio. Depending on fundamentals and market sentiment, this could be a negative sign, or it could be an opportunity to buy more at a better price. When you believe in the long-term value of a company and its fundamentals are solid, DCA allows you to gradually accumulate shares and lower your average buying price for that stock, especially at key levels of support. These are the price zones where a stock historically tends to bounce or recover. If you're buying more shares at those levels, you're reinforcing your investment while taking advantage of strategic pricing. In essence, you're building your position with discipline and confidence rather than emotion or hype. It's a powerful way to practice making informed, strategic decisions. It's perfect for beginners and long-term investors who want to stay consistent without trying to time the market. Managing risk, the exit strategy. You need. No investment strategy is complete without a clear plan for managing risk. This is especially important when dealing with stock options, which can be highly profitable, but also volatile. One of the most important tools you can use is the stop loss. A stop loss is a preset price level where you automatically exit the trade or protect your profits if things go the wrong way. It's your safety net. Personally, I buy as close to key levels of support as I can. If my prediction turns out to be wrong, the price will break that support level, and it becomes extremely clear, visually on the chart, that I was incorrect. That gives me a natural zone to place my stop loss, which is usually around 20% below my buy price. This way, I protect my capital while giving my trade enough room to move. I use a combination of stop losses and portfolio allocation to manage my risk. I calculate how much I stand to lose on any trade before I take it. If a trade doesn't work out, I don't panic. If I get stopped out at my predetermined level, I lose an amount I could afford to lose. If the fundamentals haven't changed and the next level of support is nearby, I may even strengthen my position by buying more at a better price. Risk management is not about never losing. It's about keeping your losses in perspective and keeping them small and controlled so your gains can outpace them over time. A beginner-friendly introduction to stock options. Stock options can seem complicated at first, but once you understand the basics, they offer a unique and powerful way to increase your investing potential, especially when used responsibly. At their core, stock options are contracts that give you the right, but not the obligation, to buy or sell a stock at a specific price before a certain date. There are two main types of options. Call options give you the right to buy a stock at a specific price. Investors use call options when they believe a stock's price will go up. Put options give you the right to sell a stock at a specific price. Investors use put options when they believe a stock's price will go down. Why use options? Options are versatile tools. You can use them to take advantage of trends, leverage your money, and control more shares for less capital. Make higher gains in less time than investing in individual stocks. Generate income through certain option strategies, like selling covered calls. Protect your portfolio, hedging against downside risk. When buying option contracts, there are some important things to remember. 1. Options contracts are a depreciating asset, meaning they lose value as they get closer to the expiration date. 2. Options amplify both gains and losses. Used without education or discipline, they can lead to quick and even total losses. It is not unusual for me to have gains of over 100% on an option contract within a matter of months or even weeks, but it is also possible to lose 100% of your investment. That's why beginners are encouraged to master the basics first, especially reading charts, identifying trends, support and resistance, and managing risk. Educate yourself. Develop the discipline to only buy at your predetermined levels. Build safe and secure growth in your portfolio with reliable ETFs, index funds, and strong stocks before trading options. Terms to no strike price, the price at which you can buy or sell the stock, depending on the option type. Expiration date, the date by which the option must be exercised or it becomes worthless. Premium, the price you pay to buy the option. In the money, ITM. When exercising the option would result in a profit. Out of the money, OTM. When exercising the option would not be profitable. Options are not required to be a successful investor, but if you're interested in learning more, start small, stay patient, listen to mentors, and practice extensively before going live. Another advanced strategy for investors who already own 100 shares of a stock is writing covered calls. This means you are selling option contracts on stocks you own instead of buying option contracts on someone else's stock. This allows you to earn passive income by selling the right to someone else to buy your shares at a higher price. If the stock never reaches that price, you keep both your shares and the premium. It's a great way to generate cash from stocks you already own. Tending to your garden, becoming your own fund manager. As you continue your journey, it's helpful to see your investment account not just as a collection of stocks, but as a garden, a space you're cultivating, shaping, and growing with care and intention. Every dollar you invest is a seed planted in fertile ground. With time, patience, and the right conditions, some of those seeds will grow into strong, healthy money trees, assets that consistently bear fruit. Others may wilt, stagnate, or be choked out by weeds, poor investments, emotional decisions, or impulsive trades. Your job is to tend to this garden like a dedicated caretaker. Water the winners. When a company shows strong fundamentals, make buys at key levels of support. Pull the weeds. Cut your losses on underperforming positions or toxic financial habits. Fertilize with learning. Continue studying charts, income statements, and strategies. Let your knowledge be the nourishment that helps your garden thrive. You are, in a sense, your own personal fund manager, the steward of a small but proud company that reflects your values, discipline, and vision. If you had a board of trustees, you should be able to clearly explain your investment decisions to them. The more carefully you manage this portfolio, the more it will grow, not just in value, but in purpose. My personal strategy. My personal approach is simple, consistent, and rooted in risk management. I invest around 30% of my portfolio in ETFs and index funds, being sure to include some that pay dividends. I allocate about another 30% to high-quality, fundamentally sound stocks. When I buy stocks, I assume that I will hold them for at least 10 years. This helps to make discerning choices in the market, and it develops a long-term investing mindset. Investing for the long term helps to reduce your risk, and it allows you to view market volatility with a proper perspective. In bull markets, I keep approximately 15% of my investment account in cash reserves. When the market is crashing, I keep more cash, sometimes close to 50% of my account, so I'm prepared to take advantage of new opportunities to buy great stocks at a lower price. If you trim and sell at highs or continue adding cash to your account, you will find yourself with cash to invest when prices drop. The worst thing is seeing a great opportunity to invest, but not being able to take advantage because all of your capital is tied up. Always keep free cash, especially when you see opportunity coming. Depending on my account size and risk tolerance, I allocate 15 to 20% of my account to stock options. If my price level hits, and it fits within my portfolio allocation budget, I like to swing trade call options, usually around 6 months or longer. If the option contract is too expensive, I just buy and hold the stock. I hold on to my stocks, ETFs, and index funds indefinitely for the most part, but options have an expiration date, so it is important to have well-planned entry and exit points. Stop losses are also highly recommended to manage risk and protect profits. If you have more than 100 shares of a stock, consider selling covered call options on your stock for a premium. This is one of the easiest ways to generate passive income from the stock market. Whether stocks, options, or funds, I prefer to buy at key levels of support, especially during times when the fear and greed index is showing fear. I tend to sell or trim my positions when the market hits all-time highs or when the fear and greed index is tilted towards greed. You never lose money by taking profits. It's common to get FOMO in the market when prices shoot up, but keep in mind that you do not make any money from a trade or investment until you hit the sell button. It is definitely possible to hold on to a position too long and watch it go from a nice profit to a considerable loss. As long as you aren't losing money, you're winning. Compound interest will do the heavy lifting for you if you stay consistent. Don't let hype trick you into buying at highs or thinking that the prices will go up forever. The market breathes, and sometimes it takes unexpectedly large breaths. Don't get caught in a vulnerable position. Be patient, take profits when appropriate, and wait for your levels to buy. When prices dip and emotions run high, disciplined investors quietly build wealth. When the market crashes, I start looking for long-term levels of support on companies I like, and I mark my buy prices. If and when my price levels hit, I make my buys, or dollar cost average, based on my fundamental technical analysis, as well as portfolio budgeting. Remember, buy low, sell high. Final thoughts. Stock investing is something you can start doing today, but understand that it takes time to learn. I'm still learning myself. The key is to start your learning journey as soon as possible and develop the habit of investing, even if it's just in small amounts. You don't have to know everything on day one. What matters is that you take action, and that action doesn't necessarily require your money in the beginning. Paper trading accounts can be incredibly useful. They allow you to practice trades and strategies without risking real money, simulate managing amounts of money you don't yet have, learn to interpret stock charts, get comfortable with entering and exiting trades, improve your risk management skills. But keep in mind, investing real money is a completely different emotional experience than paper trading. You will feel this difference the first time you invest a real dollar. That's why it's important to remove emotion from the equation. Start small. Build discipline in your decision-making. Learn to identify quality companies or funds that have shown long-term growth and only buy when the price reaches key levels of support. Over time, this approach helps you build your investment portfolio safely and rewardingly. As your knowledge grows, you will develop your own investment style and strategies. Whichever strategy you choose, stick to it. More than any fancy strategy or technical skill, what's helped me the most is simply the habit of investing consistently. In the beginning, it's not about being an investment hotshot. It's about practicing your decision-making and risk management. Don't forget the number one rule. Don't lose money. Start safe with ETFs and index funds. Move on to stocks, and then try options when you, your knowledge base, and your account balance are ready. Never stop learning. If you've already become a consistent saver, now it's time to take the next step. Become a consistent investor. Action step. Build your paper trading portfolio. I challenge you to commit to at least 1 year of building and managing a paper trading account using the following strategy. For now, think of it like a game you play in your spare time. This exercise will give you the opportunity to practice some investing basics, experience a couple market swings, and hopefully reveal to you the potential of your saved money, as well as your potential as a profitable trader. All without risking a dime. Investing doesn't require you to gaze at charts for hours. It just requires you to pay a little attention to get a lot of reward. Here's how. Create a paper trading account on Weibull, Thinkorswim, or a platform of your choosing. Don't start with an outlandish account balance. Start with a money amount that is realistic for you personally. This will make this exercise more impactful for you. Create a watch list in TradingView of companies you like, use, or believe in. Aim for at least 5 stocks to start with. If you can't think of any, try looking up the top companies in the S&P 500. Don't forget to include a couple ETFs and index funds. Analyze the long-term trend of each symbol using the weekly chart view on the TradingView app. Is the long-term trend upward, downward, or sideways? If you cannot identify a trend, try increasing the chart's time frame. Your first prerequisite for a stock to enter your watch list is that it has a long-term upward trend. Once you have a few worthy stocks and indexes on your list, identify key support levels for them, ideally at least 20% below its all-time high, or an area where the stock price has repeatedly rebounded. These are strong candidate prices for entry. Mark them with an alert or a line. Identify key resistance levels for each stock. When prices hit highs, avoid buys. These are the levels where you want to trim your positions and take profits on short-term positions. Mark them with an alert or a different color line. Check the Fear and Greed Index. Remember to look for buying opportunities when the market is in fear and selling opportunities when the market is in greed. Now, you don't have to constantly watch the charts. You are just waiting for your alerts. Mine go straight to my phone and smartwatch. If your alerts never hit, you just keep your money in your account and collect the interest, which is usually higher than what you'd get at the bank. If your alert does hit, you have an opportunity to test how good you are at identifying good buy and sell prices. When one of your buy zones is hit, check the long-term trend again. See if your support level is still holding. Review the company's fundamentals. Are they growing their earnings? If everything checks out, buy the stock or option in your paper trading account according to your allocation budget and practice managing that position. Use a stop loss and use dollar cost averaging when appropriate. If your sell zone is hit, consider holding, trimming, or selling your position. Don't forget, you can also use stop losses to secure profits. From time to time, reevaluate your buy and sell levels, especially when the Fear and Greed Index tilts towards either extreme. Keep doing this throughout the year. Overall, the goals are to own shares of stock in great companies at a great price, while also slowly and responsibly taking on higher risk, higher reward trades. Remember, only buy at key levels and use stop losses on all stock options. Don't buy what doesn't fit your portfolio allocation. You're not just building a portfolio, you're building a real system, one that helps you act strategically, not emotionally. With time and practice, this becomes second nature. Once you are comfortable, don't be afraid to take the next step and start managing and growing your real money with the system you've created. Stock investing is something you can start doing today, but understand that it takes time to learn. There is much more to understand than what has been stated in this chapter. The key is to start your learning journey as soon as possible and develop the habit and skill of investing. Build your portfolio, even if it's just in small amounts. You don't have to have a lot of money or know everything on day one. What matters is taking action, building familiarity, and maintaining consistency.